Today is one of the most exciting episodes in this YouTube channel. We're going to talk about gold and a complete analysis of what's going to happen to gold, what drives the price of gold, and as well some indicators that will help you understand to know what affects this asset, and as well to give you a complete market forecast and a macro picture of this precious metal. So if you think this is interesting, you should definitely watch this video. So I'm going to talk about the gold price analysis and a complete market forecast for you guys. So let's start to see what drives the price of gold. So throughout these years, throughout the last 2 decades, the performance of gold has been amazing. Just look at the chart and it has skyrocketed. Then there's a little bit of a correction to the downside, and we're now going to the upside, but we don't know what's going to happen. So what drives the price of gold? First of all, the best fuel for gold is inflation, uncertainty, the systemic collapse, and the lack of trust in the economy. So let's continue so I can tell you what is the drivers and which tools you could analyze to see what's going to happen. We have here a chart that contains the Federal Reserve balance sheet, the interest rates, and a projection of how the balance sheet will look in the future. And the gray part is just a recession mark. And why is this so important to the price of gold? Because the US dollar is the world reserve currency, right? If you travel to Japan, if you travel to Australia, to Malaysia, to Mexico, or any continent, as long as people trust the USA and their economy, it will be a powerful country, as it has been leading for the last century and part of this century, right? And remember, all the economy is just based on trust. The interest rates of the Federal Reserve in this yellow line, that they are like going up and down, right? So every time it goes up, it's the rate at which the Federal Reserve lends money to the depository institutions like banks. So when it's high, money doesn't flow as rapidly between institutions. So this means that the cost of borrowing is higher. So it's more difficult for companies and people to get a loan from the bank because a high interest needs to be paid back. And after a crisis, there is expected to go down, like here. After the 2008 crisis, they really just went almost to zero, and they remained like this for a long time until 2016, right? And here you can see the Federal Reserve balance sheet, that it's growing and growing and growing, and this is basically the money supply. This is the Federal Reserve injecting dollars into the economy through low interest rates, easing money through to the people and companies through banks. And it doesn't make any sense because they are bailing out inefficient companies and people who save money are paying directly for those bailouts because that purchasing power is transferred to them in the form of a financial instrument. And then people get taxed for it. So yield curve in the bond market is correlated to gold because investors choose between gold and bonds in times of turmoil. So I will explain why. Yield on a security is the amount of cash that returns to the owner of the security after holding it for a certain time. And when there's an expectation that those interest rates will increase in the future, means that issuers of bonds, that means all the governments, would have to increase the yield to match the market expectations, right? And this means normally this happens when the economy is running well and there's prosperity and there's like the money is flowing in the economy. So the longer the maturity time, the higher the expected interest rates, hence the higher the yield rate. So the yield will change to the upside as a result. And I will show you, the next slide is about the 10-year Treasury bond of the United States. And of course, when there's concern that the economy will enter into a recession like it is happening right now with the pandemic, there will be expectations of lower interest rates in the future. So basically, the Federal Reserve lower the interest rates in order to inject more liquidity so that we don't have these systemic problems and the banks not running out of cash, the people don't stop. There's not an income problem, right? Because some people income and spending is other people income and savings, right? Future. So bond issuers will decrease the yield to match the market. And the longer the maturity time, the lower the expected interest rates, hence the lower the yield rate. And the yield will flatten as a result, right? So excess demand will drive the price up and yield down of long date bonds, so yield curves should flatten. So I'm going to tell you these two examples in here. So let's say that when the economy is going very well, the yield curve goes to the upside. And when there are expectations of a crisis, the yield curve will go to the downside. And every crisis you can see here, it goes to the downside. Like here, 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 and recently here, right? So with this yield rate, gold converts into a great alternative of investment. Gold depends so much, and it's compared to the US dollar because it's a reserve currency of the world. And money has always been, gold has always been considered money. If you read even the Bible, gold, that this precious metal is there in the Bible or in other history books. So in difficult times, investors try to get the most secure assets like bonds and gold. But with these low returns, they tend to have more riskier assets than normal. 0.74%, it's ridiculous, right? It's not attractive anymore. So in the 1980s, yeah, it was very attractive because you will get 14% of that, of the money that you invested, right? And right now it's ridiculous. So there is a concern that the United States will basically fail as a leading economy. And as a result, gold prices will go up because they cannot keep financing themselves from the world. So this privilege given to the USA being a world reserve currency raises a lot of questions. And the dollar being the reserve currency of the world has given the opportunity to the United States to do deficit spending, right? All this chart shows you the federal surpluses and the deficits as percentages of GDP. So the United States has run a federal budget deficit most years. And it's not because they are bad government. No, it's because the reserve currency allows to do that. They basically can roll into negative, into deficit, and everybody will buy bonds. And in this case, they are financing wars, they are financing, as you can see here, the Korean War, the Vietnam War, the Great Recession, right? Because they sell bonds to other countries or to other people, and even to the same people in the United States, because most of the bonds are held domestically inside the country. All these events produce inflation because every time they issue bonds, a lot of money is injected into the economy. For example, they pay a soldier to go to war, and this soldier he saves money while he's on war, and then brings back the cash to the domestic economy, and now there's more money into existence, right? Because they sold the bond in the international market, maybe to China, Japan, Canada, or any country that holds American bonds. So these international markets or countries or people that invest in US bonds allow any government spending is financed through these markets. And when there is more money into existence, there is actually a decreasing of the purchasing power of the people because there's a huge transfer of wealth every time there is new dollars. So the purchasing power is transferred from the savers to the people or institutions that use this new printed fresh money. So every new dollar that comes into existence, it's taking away value from the dollars that exist today. And before continuing, I want to ask you to subscribe to the channel, because if you subscribe, you can continue watching all these kind of videos that are very very cool for you guys, and you can squeeze all the information out of them and share it to all your friends, please. And as well, I want you to comment below so that the YouTube algorithm helps me, and this way I can continue to upload all this interesting stuff. Every time we buy something, we're paying it with the time we used in order to get that money to pay that item, or we're paying it with somebody else's time. Time is our most precious asset and source of value. We have heard many times that time is money. We're obsessed about money, but we don't seem to care about its value. So every time we can buy less with it. So all these inflationary events and all the printing of money, they're actually taking wealth out of our existing dollars, right? If we save money into dollars, well, we can buy less things after a year or two. We're obsessed of pricing everything into US dollars, like even gold. We're always aware of, oh, the gold price went up. When there's like money creation out of thin air, well, things tend to go up, right? Prices tend to soar because there's like a lot of money that can buy everything. If you have lots of money, you buy more things, right? But if that money was created without creating value, well, problems arise, right? Like hyperinflation. So read some history books, as I told you, and let's break paradigms, because gold and silver have been kings in times of turmoil, like wars or depressions or civil wars, or until fintech arrived, you know. So let's wait and see what happens, you know. I don't want you to think that gold is king right now, because there is fintech, times are really changing, and there's not even enough gold for everybody to hold, or even silver. There's overpopulation, and not everyone can hold a gold coin. I'm going to tell you that, okay, now the US economy is in trouble, right? Like everybody knows that the debt is huge. Just look at the debt clock that you can find online, and I will put it here. You can see that every second, there's like more debt into existence, right? And that's how the financial system is developed and designed. Let's take a look at the other economies that are as well important. The Japanese government debt is held domestically, and Japan is a net saver with an annual capital surplus account. So the Japanese culture basically tends to save a lot of money, and they're very hardworking. And the debt of the GDP is already at 230%. When in contrast to the US economy, the US economy is a net borrower, and their large fraction of government debt is held by foreign investors. But most of it is held domestically as well. So everything is paid out of debt, right? Because the United States is a net borrower. So there's quite a difference there. Japan, it's at 230% in debt over the GDP, and now the United States is over 100, and it's huge, right? And it's alarming, yes, but now we don't know where is the limit of how much debt they can hold and how many years they could keep like that. So I don't know if they can restructure the debt, or I don't know, but there are difficult times right now. So I want you to change the paradigm of looking everything in fiat currency, like price everything in US dollars, price everything in Japanese yen or euros. Now, gold has been money around the world for many, many years. So if we price the S&P 500 into gold, basically things change. This is a game changer, right? Because the number tells you how many ounces of gold it would take to buy the S&P 500. So if you price things in gold, basically you have more purchasing power all the time, right? And it's money. This is money because it's not electronic. It has intrinsic value. It's portable. You can take it somewhere. You can weight it. It's limited and it's anchored to value creation, right? Because every time gold comes into existence, well, there's a lot of energy and involved because there's mining process, there's as well the processing of the precious metal and everything, and value is created. And now the difference between $0 and $1 million is just 7 computer keyboard strokes. And I will show you now the US dollar currency index. We can see that in the long term it has been it's a downtrend right now, and it's the dollar currency index is basically comparing the US dollar to the other most important currencies, right? So now the dollar has overperformed, let's say, over the other currencies, because when a crisis arises, everybody wants to be liquid there. You know, you want to pay your bills, you want to assure your money, you want actually cash, because when there's like a financial crisis, everybody wants to be able to pay their employees, so that there's not a liquidity problem in case the bank goes bankrupt or something, right? I think now in this crisis, the dollar currency index, the dollar got stronger, right? With all the quantitative easing and all the money printing, well, it should go down somehow, right? And every time why the gold and the dollars are connected. Here you can see a chart of how they are really connected. When the dollar goes down, well, the gold goes up, and when the gold goes down, the dollar got stronger. You can see that the gold got stronger, and then there's like a correlation, an inverse correlation here. It's very clear, right? This line is a bit flat, but this is because I put it into the system in TradingView, and well, it's not very clear here, but you can see that it's correlated. Don't consider this indicator as the only one to follow the price of gold. You can use another momentum indicators like the RSI or the MACD or the Ichimoku clouds, whatever you want, in technical analysis of the price of gold, but this is highly correlated. As well, I want to show you the gold and silver ratio, and this is basically telling you with how many ounces of silver you can buy an ounce of gold, right? Right now the current ratio is at 98, around 98 points, and the all-time high has been 115, which is in recent years, it's a great opportunity to buy silver right now. And when the gold and silver ratio is running low, let's say, it's the best time to buy gold. And this case has been around 2011, right? So this is also an indicator that you should be aware of. Every time if the gold silver ratio goes down, well, it's time to buy gold, and when it goes up, it's a best time to buy silver. In ratios, it's one of the most accurate ways to value things and to get the best timing to buy some assets. We don't get confused by all the money printing and all the bubbles that everybody's concerned about how much money is printing the US, and really like people are scared, but don't be scared, because the US dollar is the world reserve currency. The United States knows with accuracy the demand of dollars throughout the world because they have swap lines installed in a lot of countries, and this has increased over the last decade dramatically. The best Troy horse that the US economy has is all the swap lines that are in emerging economies like in Mexico or in Brazil, Turkey, or Argentina, and other countries. They basically can know how many dollars the other economies are demanding, right? So after the 2008 crisis, demand of US dollars in economies like Japan, in economies like Canada, Mexico, actually skyrocketed to over $60 trillion in recent years. So this is the performance of the fiat currencies of other countries like Mexico and Brazil, which are these two lines. And this is how they performed in the March crisis of 2020 with the pandemic. So they basically just went to the floor. This is super negative for these economies, and this is really good for the US dollar because they are demanding dollars. The problem is when these dollars go back to the USA, and this is when hyperinflation could kick in, which would be the best scenario for gold, right? And as well, this is alarming because the high yield bond differentials, according to the swap curve, spiked in the pandemic, and they started even before all this turmoil, all when everything was happening in the news, right? So treasury bonds depressed their yields below true nominal risk, and the free rate resulting in a steep increase in risk premiums, right? And this means that there's a lot of credit risk and liquidity problems in other economies, not in the US economy. For example, economies like Mexico and Brazil, they have their reserves in US dollars because this way they can buy against their currency and stabilize the economy. So these economies are basically dollarizing because they lose so much purchasing power through the years that it's just unbearable for business people and savers, right? So there's lots of demand, right? And what does it mean to have a weaker currency? So right now Trump is very furious because basically all the US industry is declining because as people lose purchasing power and the currency is weak in economies of cheap fiat currencies, the labor force gets very, very cheap, and this is fertile ground for international companies to open factories. This way they have higher margins when selling the products in the domestic markets because they were imported and produced abroad. In the case of China, China has been devaluing their own currency in order to get this cheap labor force. And how do they do that? They just purchase treasury bonds from the United States, and this way the transactions of the local currency never happens, and there is no demand for the local currency because of this. As I told you, when there's like this de-dollarization in other economies, this is the beginning of the end of the dollar being a strong currency. But right now there's huge demand, and more in times of turmoil like today's world. So I don't see that this is not so the best scenario for gold, but of course when these central banks all over the world are printing till death all the currencies, well, it's a fertile ground as well for the price of gold to go up. But don't forget the demand. And this is as well VIX. It's basically like a volatility index. So this is two scenarios. What happened in 2008, you can see this yellow line that gold went down at first, the volatility spiked, and then basically the gold price went up amazingly, right? It performed very, very well when the market stabilized and there was less volatility. And now it happens the same. Basically, the VIX went up, spiked. This is the blue line in today's, and it went down, and the gold price was low, but then began recovery. Now, I guess it's the perfect time, and I'm sure that it will go to the upside in the short term, right? And this is the gold performance versus the domestic stock index and the local currency. So this is the annual performance in 2020, let's say from January till now. And this is the perfect example of how gold could counterbalance the bad performance of an investment portfolio. It works as an insurance for your portfolio because it reduces the volatility of your portfolio, and basically when things are going wrong, you can have a percentage of gold and reduce the risk. It brings, if you have an investment portfolio, it is great to bring stability to your portfolio. Now, let's talk about the gold manipulation. The perfect manipulation for gold is like the perfect diet. So it is difficult, but it is possible, right? So, but let's consider this. Investors should also not forget that for each seller of a futures contract in the commodity, in the COMEX, there must be a buyer. Thus, the practice of naked gold short selling, existing or not, cannot explain the long-term bear markets in gold. So it's not easy to manipulate gold anymore. And central banks, do they have the right conditions right now? Collecting gold for them, it's more desirable, or basically pushing. I guess that they're right now against the use of cash, right? They're all the time trying to collect more taxes and pushing people to go to debits and credits, which is electronic accounting, and they are pushing people to be more accountable for them. So I don't know if the central banks as well are interested in manipulating gold, because people will find gold more attractive, and this is a way that they lose control over population. So states are doing all in their hands to perpetuate themselves, including currency debasement, and they cannot fail because they can pay for all things priced in fiat, including jobs. And this is a Keynesian approach. And as an alternative, they can buy dollars in the case of other economies, right? As I was explaining. So please watch my video of MMT. I will put it on the corner, and you will understand what I'm saying, right? So we're not living in a communist or capitalist world. We're living in a world where we have states, and they want to perpetuate their power. And I want to talk about the velocity of money as well. And I will tell you that this indicator of the economy is very, very important, because it is the number of times $1 is spent to buy goods and services per unit of time. It's basically how many times a dollar was used to create value, right? If you pay your taxi driver, it produced value because you got transport from point A to point B. And if you paid your accountant, well, value was created because he helped you. And every time you went to the doctor, well, you paid, and that's the same. So it's the number of time $1 is transferred to other people, creating value. So when the velocity of money rises and all other things are being equal, which is this formula, so the velocity, and this is the prices and the transactions and the money supply. When all things are equal, the buying power of money falls, which is the opposite occurs when the velocity declines, which is basically we have now a deflationary process, right? But what happens to price? If you see this formula in another perspective, which is the P, is just, well, in contrast to the other ones, if you increase the monetary base, okay, the prices will go up because there's just so much money, and hyperinflation could kick in, right? So, and also the economy has a psychological part. For example, when there is crisis, what triggers fear and greed, it's because the people's psychology leads them to take all their money out of the bank, and that's why they go bankrupt, right? So don't forget the psychological part of the economy, and this nobody has control, not even the Federal Reserve, not even United States, or even the most powerful people in the world. Okay, so this is a psychological part that we cannot forget. So right now, this is the velocity of money. Basically, people are not creating value, everything is going down, and the Federal Reserve is trying to save this. And what I'm concerned is that with all the money printing that we saw, there is a point when this will turn out positive, and this is where hyperinflation will kick in, because all the money will be spent into goods and services and everything, and it will soar the prices, and then our purchasing power will be on the floor. So I hope you understand all this gold analysis and why it's important to have gold today. Consider all the indicators and do a research-driven approach to this asset. And as well, please subscribe to the channel, share the video, and of course hit the 2 thumbs up and this will help me a lot to increase my number of likes and views and everything. And it's really good because I can continue giving you good information and valuable information, right? And if you comment below as well, it will help me to succeed, right, in YouTube. And this is really, I want to share all this information because I want people to know these things. And well, that's everything. And thank you so much for arriving until here. Bye bye.